In this video, we're going to continue talking about discounted cash flow valuation. So let's start with just an expansion of a topic we've had before, which is to talk about annuities. Now, the strict definition of annuity, it's a fixed cash flow for a certain period of time. But sometimes there'll actually be some strategic growth. Could be due to inflation, could be due to maybe you get a bonus at work, so you increase the amount that you invest on a monthly basis. But there is potential to strategically incorporate growth into these payment streams, if you will. And you can see that the formula is drastically more complicated than it was with the previous formulas that we've talked about. Now, unfortunately, there's no Excel formula for this. So when you incorporate this or go to do this, the spreadsheet is much easier since I've already done the problem for you, or the formula. So here we're back to our friend Fred, who is saving $2,000 a month for 40 years. We're making compound frequency, but we're also now going to assume a 4% growth. So as you remember, we said the ordinary annuity without any growth is 1.9 million. If this cash flow of $1.66 grows 4% annually, of course, we would do that on a monthly basis, but if it would grow by 4%, the future value of that growing annuity would be 2.8 million. So again, this small 4% increase annually brings us roughly an extra $1 million, almost exactly $1 million, just about $100,000 shy. So the new answer with growth is 2.8 million. Now the next discussion point then kind of reverts a little bit back to this compound frequency information, right? So why is this all that important? Well, the effective interest rate is the actual interest rate that you earn when you invest. But the nominal rate, that's this annual rate here, the I divided by Y or R, right? This interest rate, right, does not incorporate compounding of money. So if you compound once per year, you would earn, again, 12%, exactly what the annual rate is, because you only calculate interest once a year. But what if you compound more frequently? What if you can compound monthly? That 12% earnings is, again, nominal, it's annual. We want to convert that to what is the actual, the effective interest rate. The effective interest rate is 12.68%. So if you invested $1,000 at 12% with just one compounding, you would end up with $1,120. But if you could compound that, and it could compound monthly, you'd end up with $1,268. You'd have an extra $68 that year because the interest is earning interest on a monthly basis. Next, we want to switch gears again, and let's look at some application concepts, right? Some application processes, if you will. Ray Noble purchased an investment 4 years ago for $1,250. It's worth $3,000. What is the compounded annual rate of return? So we input the numbers, 3,000. Remember, present value, since it's a beginning amount, present value is almost always going to be a negative number, negative 1,250. So what is the actual return? The return on this investment is roughly 24.47%. So that's the annual rate of return on an annual basis, obviously, compounded annually on this investment for Ray. Now, what about time, right? So, we want to figure out how many years it's going to take $1,000 earning 8% to grow to $2,500. So simply stated, right, at 8%, how many years does it take 1,000 to grow to 2,500? Again, inputting the data, as you can see here, compounding frequency 1. If you leave time and years blank, then we will end up with time, solve for time, 11.91 years. Now, that's a nice question, but not really the best question for time, right? So typically, when we think about asking questions for time, you want to ask questions about doubling. How long does it take for your money to double? Now, we have an approximation for that. The approximation is called the rule of 72. So 8% divided into 72 says roughly it takes 9 years for a number to double. So here we have, if you actually do the math, how long does it take $1 to double to 2 at 8%? And the answer to that is 9.01 years. So this rule of 72 is a pretty important number if you think about just trying to understand how growth works. Because most people assume that if you double interest, you double the amount of the investment. There is a video on the rule of 72 that I would suggest that you take a look at, and to try to understand why this is so important for investing. The next application is an application for loans. Now, loan amortization is where we write off a loan's interest and payments over time. The write-off is done in equal payments. Each one of those payments is part interest, part principal. And how we can track that is through something called a loan amortization schedule. And you'll see how that works here in the next couple of minutes. The reason loan amortization is important and the ability to segment things into interest and principal is because interest is tax deductible, but principal is not. Right? If you think about if you buy an asset and you're making payments, right, you're certainly going to make payments on the loan. But because you purchased an asset for your business, you're also going to depreciate that asset. So you can't write the asset's value off twice, once through depreciation and once through the loan. So we segment principal and loan, or principal and interest, so that we can identify interest expense. There is a loan analysis worksheet that you can utilize. You plug in the amount. Here's $6,000. It's a 4-year loan. Now, to make this a little simpler, we only use one payment per year. Obviously, more realistic is you're going to make monthly payments. And the interest rate's 10%. So the payment per period is $1,892. If you made all 4 payments, you'd pay $75.71, and the total cost of financing over this year, these 4 years, is $1,571. It's just $75.71 minus the loan amount. Now here's the loan amortization table, and in this worksheet, you just scroll to the right to find that. Here are the payments. Here are the interest pieces for each payment. So $1,892 was the payment. $600 of that was interest. That must mean that $1,292 went to reducing the loan. $6,000 minus 1292 leaves 4707. And likewise, we continue that to the very last payment, where you see at the end, the loan is completely paid off. So that is loan amortization. The next thing we want to briefly introduce is the corporate concept of valuation, really. Because if you think about a company is never going to have equal payments. They're always going to have unequal cash flows per year, if you will. So this company is considering a new product line. They expect a return of 13%, and the following table is going to have those cash flows. So these cash flows, years 1 through 7, came from the process of identifying the actual income statement each year for this project, predicting that, calculating its future cash flow from our formulas. And again, we'll talk about this later when we get to talk about some videos about capital budgeting. But what is the future value of these cash flows? Again, what is the future value? So actually, I apologize, this is the present value. The present value of these cash flows is $292,632. If you were to find the present value of each one of these cash flows and add them together, you would get $292,632. Now, what's the future value? If instead of bringing these back to time zero, if you invested $80,000 at 13% for, again, this would be 7 minus 1, 6 years, and you reinvested each of these, the future value of the cash flows would be $688,449. Now, this comes from your mixed cash flow time value of money worksheet. This doesn't come from the more complicated, the more specific capital budgeting cash flow stream worksheets. So this comes from time value mixed cash flow worksheet. So that's the end of this video. I look forward to talking to you in the next video.